Good morning.
Hey, Dima, how you doing?
Pretty good. How are you, Will?
Morning show number 3. I'm super excited. I'm doing well. Thank you.
Thanks, Will. So good morning, everyone. Yep, third pre-market show. Will, do you want to get started? Or are we waiting a little bit?
Well, we can wait a little bit, go over some basics. Hey, everyone on YouTube, thanks for joining us. This is streaming live on YouTube. Leave any questions in the chat. You can start. Let us know if the sound is good for everyone. Dmitry sounds great to me. Sometimes it doesn't transfer well. Let us know if you're hearing everything correctly. If you have any questions, leave it in the chat. Other than that, we can probably get started, Dima. Do you want me to?
Yeah, do you want to do the disclaimer really quickly, Will, before we go?
Yeah, let's do
into
that.
it. So yeah, everyone, we're just going to put up a disclaimer. Remember, we're not investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you are looking for investment advice or recommendations, please contact a professional or your broker. Again, here's the disclaimer.
Excellent.
And
nice job as always, Dima. You want to share your screen and show us something interesting today in the pre-market movers?
Yep. And today, let me just really quickly, let me know if you see my screen.
Oh, it's there. It's there.
The pre-market?
Yep, looking good.
And I was going to go over, I'm going to try to go as usual, like pretty quickly, kind of run through some summaries, get later to leave some room for questions. Also, a couple people did send a few questions I wanted to address before we get into analysis. We had some questions. Well, what is pre-market trading? What is going on here? And pre-market, this is right now we're looking at a report, and these are stocks that are trading pre-market before the market opens. And what we're seeing here is the change of the price, the percentage change here from yesterday's closing price and the volume in the pre-market hours. Now, pre-market's a little bit different because during regular hours, which is 9:30 a.m. Eastern to 4 o'clock, those are considered regular hours, and that's when you have all the participants, mutual funds and big institutions that are entering in their orders. The VWAPs come in. Now, that doesn't happen in a pre-market hours, so you don't see mutual funds, these institutional VWAPs, they're not active in those pre-market hours. So another thing is that during pre-market hours, you also you have different rules. So you don't have the same protections during regular hours. Market makers don't have any obligations during pre-market hours. So this is a little bit more like the Wild West where you're kind of on your own. So you're allowed to trade, but it's not the same rules or the same participants that you see in regular trading hours. That's why they say that, it could be very liquid and you got to be careful. But what it does do is kind of give us an indication where the traders who are participating, where they think that the prices, where the stocks are going to be repriced. Now, having said that, I'm going to take a look at the first one.
D, before you go any further, we're hearing that it's showing up a little blurry on YouTube. I just want to check your video real quick. Make sure it's on. So if you're on the bottom and you see mute and stop video, if you click on the arrow button to the right of stop video, I just want to make sure you're checked HP Vision HD camera. That there's a check next to it.
How do I do that on the video settings?
It should say select camera.
I just have integrated webcam. That's the only thing I have.
And it's checked?
Yeah.
All right. There we go.
Is it still fuzzy? Do you want me to get out and back in?
Yeah, you can try jumping out and getting back in. That'd be great. I'll
Yeah. You sure? Yep. All right, let me try to do that real quick, see if that helps.
All right, everyone, listen, while Dimitri's coming back in, let's talk about a few things on YouTube. We are trying to help everyone and grow our YouTube audience. So please like us, subscribe to us. If you subscribe, what you do is you get notification when Dmitry launches any new videos or we go live. There is chit chat about going live interday if we see things on the Chameleon. Let me know, do I look blurry? I know Jake thinks I look terrible, but Brian, do I look blurry? looks clean here. So what can I say? Let's wait for Dima to come back in. If there are any stocks you want to talk about today, have Dmitry look at, pop it into the chat. I'll get it to him. All right, Dima's back. Hopefully that works. If not, we are going to go with it no matter what. Let's share your screen and go, D.
Okay. And I think that you also mentioned while we're setting this up, somebody mentioned what is relative volume. So relative volume, we had that question kind of come up a couple of times. And what relative volume is, you're taking what today's volume is, how many contracts traded hands, or how many shares traded hands, and you're comparing it to what on average it trades. This way you could get a sense of, or is today's volume in that particular stock high or low compared to what it trades on average. So for example, every stock has a different amount of shares that trade. Will, can you see it fine?
It looks fine to me. It may be
Okay.
something we have to take. The reason it's going to YouTube, maybe something in your settings. We'll look at later. Let's just keep going.
Okay, so that's what relative volume is just the way of comparing today's volume to historical averages. And a little bit later, if we have time, I'll show you how that works. So yesterday, these are all those stocks right now in our report that are moving in a pre-market. We know like one of the big ones that pops up here is Netflix. So let's just take a look at that. It reported earnings. It's down 7% right now. I know that it did pretty well. I think it added like 10 million new subscriptions. They're expecting 8 million, but then maybe something in their guidance that people aren't happy about. So right now it's down 7.4%. Let's just take a look at, just to analyze it from a historical perspective, how much does it usually gap? So this is right here, Netflix. I brought up a kind of like a historical analysis sheet, and here we see that over here it did close almost, it's been as high as 575, 527. So I think that even coming into the earnings, there's a lot of already enthusiasm. So maybe it's giving a little bit back, but let's just see what it tended to do during earnings. And I'm just going to put this earnings analysis here, and let's just see historically. These are the last 12 quarters of earnings, and here are the gap moves. So we see that it did tend to open lower more often than open higher, even though the average is like 0.7%. And as far as the magnitude of the move here, on average, the magnitude of move in either direction has been around 5.9%. The highest move at the open last 12 quarters was 13.4%. The lowest at the open was 0.3%. So we could just come down here and see, like right here is 13.4% on July 16th. Let's see what happened afterwards. And we see that after it opened down that much, by the end of the day from the open, it gained 9.4%. Another observation that I'm making here is that here's the average move at the open, 5.9%. And then by the end of the day, that average move from the previous day's close was 5.1%, which is kind of indicating that it tends to close the gap a little bit throughout the day. So the magnitude of the move in the morning is higher than the total magnitude of the move by the end of the day. So if it opens a lot lower, it tends to increase. A lot higher, it tends to decrease. That's what this is kind of indicating right here. We also see that historically, from the opening to the end of the day, it tends to drift lower. So over here, you see 73% of the time, the last 12 quarters, from the opening to the close, it tended to drift lower. Another here observation I see from the opening, so that's after it opens up, from that opening to the high, on average to the high, it's increased by 2.2%, versus from the opening to the low, 3.1%. So that kind of gives you the range from the high to low, and there's a little bit more bias to the downside. And the next observation that I'm seeing is that after earnings, going out 1 day, 3 days, 1 week, or even 2 weeks, it tended to the share price tended to decrease. So we could see here 1 day on average it lost 0.7%, 2 day, 3 day, and we see the number of times it decreased versus increase. So that looks like it tended to decrease more often than not, and that might be due just the enthusiasm leading up to into the earnings. Because here's before earnings, we see that it tended to increase heading into the earnings, and then tended to decrease heading out of the earnings. So this is just a really quick analysis of the distribution of returns from a historical perspective. Let's just really quick, I'm going to look at how it tended to gap down even on non-earnings, just to see, where this falls into. So we see here the gap down moves on average have been 4.9%, as high as 8.8 and 3.2. So it's not like way out of the range of its historical gaps. I'm going to go to Netflix really quickly, and let's just see from an earnings perspective. Let's take a look at the options from an earnings perspective. So here is these bars here. This is what the options predicted the move to be in either direction, up or down. And we could see here, this is as of last night, the move, that after hours move was down 9.1% compared to the expected range of 7.8% up or down. Right now, it looks like it's closing that gap a little bit. It's not down as much as it was after hours. And on average, we see here that Netflix, the markets overestimated the move 62% of the time. On average, it was implying a move of 8.6% up or down versus an absolute of 6%, which is about a 2.6% differential that the markets tended to overestimate the move. Here we also see that the straddle, where you're buying call and put at the same time, day before earnings, holding it to the day after, that was only a winner 27% of the time for an average loss of 32%. So the opposite would have been a gain if you're short the straddle there. The strangle did worse. It was only winner 18% of the time versus a 51% loss in premium if you're long that straddle. Looking at the credit iron butterfly, that was a winner 70% of the time for an average of 73% gain in the last 12 quarters. And the credit iron butterfly, where you're selling an out of the money call spread and an out of the money put spread at the same time, that was a winner 80% of the time for an average of 41% gain. So for options players, I'm going to look at one more thing here, and let's just take a look at what did the implied volatility tend to do the day after earnings were released. This is telling me here that on average, we're pegging it to a 30-day constant maturity. So these are options with 30 days out, not very close, but 30 days out that have a little bit more vega. On average, the implied volatility decreased by 31% day after earnings. So the day before, the average implied volatility was 50.8, day after 34.3, and then looking 5 days out, it pretty much stayed right there at 34.9. And let's just see what that looks like. So this is the averages that we were talking about in the last 12 quarters. So this is the average implied move day before, the day after. This here was yesterday. So the 30-day, remember, not the very near term 30-day constant maturity, that option went out around 64.4, which we see is closer to the higher range. This is the range of these 12. It was as high as 74, as low as 40.2. This was yesterday 64.4. It was on a higher range. We'll see where that ends up today. So here we also see that this is where the implied volatility, this is the average, 52.26 was on a high end the day after, 28.4 on the low end. So If it overshoots to the downside, here's your average marker. That's the mean. Overshoots to the downside, that could be an opportunity. If it opens up too high and you're expecting it to come in, these are your benchmarks right here. High, low, and that's the mean coming out. Sorry, I have to move this. This is coming out 1 day, 2 days, up to 5 days later. How did it drift? So you could see here it pretty much stayed stable. So that's a really quick scenario for Netflix. And I wanted to then get into, unless there's questions, well, I'm going to look at what's upcoming, the upcoming earnings really quickly. So you could kind of.
Yeah, that's fine. Go there.
Okay. So we're going to go to, these are earnings that are coming up. They're reporting in the next 2 weeks. So I'm going to go here to the next 2 weeks. Let's just look at the higher market cap stocks. Let's see, over 200 billion. So here I see Microsoft. That's expected July 22nd after the market closed. The current straddle, I'm looking at from a perspective of a movement in either direction right now, is implying 5.9% move in either direction, up or down. So let's compare that to what Microsoft actually moved historically. So we see here in the last 4 quarters, the average of the absolute moves was 1.5%. In the last 4 quarters, it's moved as much as the high move was 2.8%. The minimum moves was almost unchanged, 0.1%. In the last 12 quarters, the high move was 6.4%, low move 0.1%. This is the average. So we could see here that 5.9% is above that average, and this is the median move, 1.8%. So this is kind of a starting point to see what is the market estimating versus what did Microsoft actually tend to do. And also another observation is today, the markets are implying a 5.9% move. On average, the options implied a 3.9% move in the last 4 quarters, last 12 quarters, 4.1%. So even the markets are anticipating a higher move than they usually do. Another one, here's Intel. That's expected to report July 23rd. Again, this is right now, the straddles are implying 6.9% move. That compares with a historical 4-quarter average of 4.4 and 12-quarter average 5.3. Facebook, that's another one. That's implying a 10% move. That's reporting July 29th. So we still have a lot of days to go for that one. But right before earnings, we see here that on average, this is what last 4 quarters, the absolute average move was 3.8%. In the last 12 quarters, that was 6%. So this you probably want to still wait till it gets closer because we still have some time for Facebook. And then there's Google, that's going out even further. Right now, there's a 7.4% expected move in either direction versus a 4-quarter average of actual move 6% and 12 quarters of 4.6%. Let me show you one more thing that I saw. I'm going to move away from the earnings right now, Will, and let's just take a look at like the sectors that have been doing well. And I'm just using this in my watch list. So I just default my watch list to the S&P 500 sectors. And here I'm just looking at an observation in the last 2 weeks. The one that performed the worst right now, and that's actually down last 2 weeks, is the real estate sector. The ones that's been the best, actually, materials, financial, communication. The other thing is I was actually surprised that for the year, the market kind of bounced all the way back, but for the year, that energy sector is still down 34%. Financial sector still for on a 1-year basis, that's down 11.8%. And then here you got the real estate sector. So a lot of these sectors that are very, seems like dependent on leverage, a lot of borrowing, they're still performing poorly, especially if you have like a lot of leverage and on like a tech stock and you have to pay that debt. And if you don't have enough money coming in, those seem to still be struggling here. And I'm just going to go here to that energy sector. And let's just take a look at what's in there and see. So this is the ETF, Energy Select Sector ETF. And let's go to, oops, sorry, the holdings. So here are the holdings in that ETF. So we could just see in 1 year, here we go, like, these are the Occidental Petroleum, that's down 66%, Diamondback Energy, Devon, Schlumberger down 53%. So you could see that these stocks still really got smoked. And it kind of gives you like a comparison of these different sectors. And you could drill down and just get a sense of what stocks are doing, how they're doing for the year and relative to each other. So you can see which ones, let's see if there are any up for the year. Yeah, so I don't even see that. So Will, do you want to get to some questions? Just so
well, I mean, it's amazing the amount of chit chat on YouTube. And fortunately, you have someone like Jake who's in there and he's answering all the questions. But someone was asking,
great.
It's super helpful.
Jake's one of my favorite customers. We talk all the time. I know Jake worked really hard on his watch list, and he offered to share it with the community. So I'll take a look at it because I know he's actually worked really hard segmenting and categorizing his watch list. So that will be, I think, very helpful to the community. If Jake still doesn't mind, I'll take a look at that.
Nice. Maybe we'll have Jake on the show.
Yeah.
But Jake answered it. But if you want to go into, they were talking about implied vol crush
Sure.
after earnings, if you want to discuss that.
Sure. So let's go back to we could go back to Netflix since we were looking at Netflix here. And just what is the question about the implied, like what that means?
Well, I think they were talking maybe about Netflix, but as Jake saying, I mean, it's a very thorough conversation, but I just, if there's something you want to say about it, it was just a topic of conversation and everyone likes to hear your thoughts on it. That's the only reason I was bringing it up.
Right. And so one of the things, let's just go like to the options chain over here. And when we were talking about, let me move this up because so when we're talking about, the implied volatility crush for 30 days, I went to the August 28th, which is the closest to 30 days. And this would be something like, right here, what do we expect these to fall? And usually we said like 30%. So I'm just going to create like a strangle here, 490. And you could just create any strategy here. So this is what, this is what it kind of looks like at expiration. But where would we expect it today, right? So one thing is we could just decrease this by 30%. I'll just say, let's just put 40. And I don't know, whatever, 43. So this is where we think it might end up being today, for around 43 based on the historicals. And then where would we see it today? So this is, that blue line is where we would expect that straddle, that P&L from yesterday to end up kind of right there. And that's how you would just use that to kind of anticipate like where you think it would fall around. Another way we could do is look at historically here in the last 4 years. So this is where the credit went out yesterday, $46 for that straddle. Remember, I'm going out 30 days because it has more vega, unlike the very near term, which has more gamma. Most of that premium was based on the move. They're going to expire soon, but these have actually more vega in it. So that's why we're looking at the implied vol at least 30 days out. But here we see that even where it went out $46. That's the credit you would have received. If we used the average implied volatility for options in the same scenario, one day before earnings, 31 days out, just like this. See, so the machine just picked out the same scenario as it was yesterday. On average, if we use the implied volatilities for all these earnings dates, it would have been 34. So we see it's been priced higher than that. And I'm just going to go to the payout diagram and say, here, where do we see it coming out today? If the implied volatilities return, and let's just say to the 70th percentile. So this is what the P&L would look like around the curve, that blue line. So if the implied volatilities came down, but to the 70th percentile, not all the way to the mean, or the 50th percentile, that's where you would expect that P&L to be. Does that help?
Yeah, that's super helpful. I had 2 stocks. I don't know if you have time to look at them real quick.
Sure.
Taiwan Semiconductor.
What is the symbol for that?
TSM.
Okay. And is there a question with the stock?
Just people asked. I mean, you can, I guess, first let's see if there's earnings. Let's just take a look and see if there's anything that pops up for you.
There's no specific question, just the stock itself.
They just put the symbol, yeah.
Okay. Unless I have a question, I don't know actually like what you want me to analyze about that stock. But here's
when is earnings in it?
So right now it looks like that. Hold on. July 6th did it just report earnings? Let me just see it real quick. I think that it already reported earnings July 16th.
All right.
Right. So, I could really, unless you give me a specific question, if you're just throwing out a symbol, I don't know from what perspective you're trying to look at it, options, unusual option volume. I could just tell you this, that right now, or let's see, I could tell you it's been doing pretty good, right? So here in the last 2 weeks, it's up 13% versus the market 2.7. In the last 3 months, it's up 27% versus the market 15.4%. So I see that on a relative basis, it's been doing pretty well. Actually, I noticed that. Let me see Netflix. Let's see how that one did. Since now it's coming back. And this is maybe one reason that it's just kind of selling off a little bit. Because it did perform really well. Look, in the last 6 months, it's up 55% versus the market 2.2%. And even the last, 2 weeks, 1 month, it's been really outperforming. So you could just have a little bit of a pullback, really. Any other questions?
Someone says it's actually their YouTube acronym is K. I actually have a question about IV skew. Is that about how you choose a strike price? How do you look at IV skew? I mean, I guess just you're on Netflix, like looking at Netflix IV skew. Is there anything particularly Dmitry looks at when they're looking at skew?
I will a quick way to answer that, because you could talk about skew for days and you really kind of have to understand it. I don't think I could just give you a lesson in a minute, but really skew is the difference between the implied volatility and strikes, which always exists, so you rarely see where the implied volatility would be the same for every strike within an expiration and even going out in expirations from 1 month to the next, you're going to see a skew. And I just kind of look at the risk reversal really quickly, because that's just comparing a 5%, and this was on a 30-day constant maturity, a 5% out of the money put versus a 5% out of the money call, and where do they typically trade? And you see here, like in Netflix, really the skew is pretty flat here. So this is like, usually it's flat. This is what it's saying is if you bought the call and sold a put, it wouldn't cost you anything because the put would finance the call. Yesterday went out where the call was actually skewed higher, so it would cost you 0.7%. So it looked like maybe the skew was to the call was a little bit higher than the put. So maybe there was a lot of more enthusiasm to the upside, or it could just be hedgers to the upside. But at least here, that's what this has shown me really quickly, how on a 30-day constant maturity, the skew yesterday was pricing the calls higher relative to the puts on a relative basis on average.
Now, the page you're on right now is one of the great new features, I think, the benchmarks. I mean, you can look at a bunch of different strategies, and Dmitry and the whole development team worked really hard on setting up this benchmark, and it's just an unbelievable feature. So
yeah, it's really quick, especially if you have a set of strategies in mind, and before you go to the options chain, because it's really hard to view from the options chain how are options priced versus each other especially when you're doing like a complex order. So using those benchmarks can kind of just point to you where to look at on that options chain, and really quickly you could just tell, oh, the calls were priced higher relative to the puts yesterday. So the buying the put versus selling the call was a better deal yesterday than the reverse. That's what this was saying.
All right, dude, the bell's about to chime. We're
okay.
At 9:26. Everyone's got to get in front of their monitors and get ready to trade. Lively discussion today. Great job, D. Great first week, I think.
Thanks, everyone. We really appreciate you joining us early this morning. Have a good trading day. Have a good weekend. We'll see you guys next week.
Yeah,
thanks.
That's good.
Yeah.
Thanks for joining us, everyone. Great show, great week. Dmitry really bringing some great stuff all week. We start next week on Monday, same time, same place, and we'll see you. Have a safe weekend, everyone. Thanks, D.
Bye. Good night.
Bye-bye.
Bye.